Hello everyone. I got a request to show how I journal, how I track my trades, my internal dialogue and emotions, and the system that I follow to protect capital and be consistent in my trading. So in this video, I'm going to show you the full system I use for my overnight analysis, to execution screenshots, portfolio tracking, and risk review. But before I do all of that, we need to establish the mindset behind the system, because journaling becomes much more useful when you stop thinking like somebody trying to win every trade and start thinking like somebody operating a business. Imagine that you own a lemonade stand. Nobody opens up a lemonade stand expecting to collect revenue without ever spending money. You need lemons, sugar, cups, a table, inventory, right? Sometimes demand is lower than you expect. Sometimes it rains. Sometimes you prepare correctly and the day still does not go your way. Trading works the same way. Your brokerage or prop firm account is the business. Your capital is the inventory that allows the business to keep operating. And each trade is a decision to allocate some of that inventory under uncertainty. ICT often says that we are professional risk managers. That identity is important because it gives us permission to be wrong. We can take losses, we can miss moves, we can be offside. We can even go through periods when we are not reading the market especially well. Our job is not to eliminate those inevitable expenses. They're going to happen. Our job is to manage them impeccably so that one normal loss never becomes a blown day, a blown week, or a blown account. Every business needs standards before it opens. Before a lemonade stand opens, the owner should know what the business sells, when it opens, what it is allowed to spend, and when it closes. A trader needs the same standards. What market and model do I trade? What time window am I allowed to engage in? What confirmation permits an entry? Where is the idea invalidated? How much can I risk? What conditions end the day or the week? If none of that is defined, your cash register becomes the only judge. And if there is more money in the account, you assume you traded well. If there is less, you assume you traded badly. But the P&L by itself cannot tell you whether the business was operated correctly. The journal needs standards to compare your behavior against. Otherwise, you're not reviewing a process, you're only reacting to an outcome. And as a professional, you have to be completely detached from the outcome. It's important to realize and understand the difference between a good business expense and an unnecessary splurge. This is where the lemonade analogy becomes useful. Buying the normal amount of lemons is a necessary business expense. Buying 10 times more because you're emotional and hoping demand suddenly appears is a splurge. In trading, a valid setup reaching its stop is a business expense. Being wrong about direction while respecting predefined risk is a business expense. Missing a move because your criteria never appeared is also acceptable. You protected the business instead of chasing revenue. Over-leveraging, revenge trading, chasing a missed entry, moving a stop further away, or continuing beyond your loss limit are not the normal business expenses. Those losses were created because the operator abandoned the plan. And remember, as professional traders, our job is to impeccably manage risk. A controlled loss taken inside the business plan is an expense. An undisciplined loss created by violating the plan is operational negligence. The journal forces you to identify which one you actually took. And your fundamental job as a professional risk manager is to completely eliminate all unnecessary splurges. That brings us to the purpose of the journal. The journal isn't just a place where I keep a record of my entries, exits, wins, and losses. That's probably the least important part of it. For me, the journal is really the holy grail of my development as a trader. It's where my confidence comes from, because instead of relying on how I feel about my trading, I can actually look back at evidence of what I do well, what I struggle with, and what I need to improve. And that goes way beyond just the technical side. The journal helps me develop psychologically as well. It starts exposing patterns in my behavior that are really hard to notice in the moment. Am I overtrading? Am I hesitating on perfectly valid setups because I'm afraid to lose? Am I chasing trades because of FOMO? Am I forcing something because I'm frustrated about the last trade? And over time, these patterns become impossible to ignore, and that's what makes the journal so valuable. It helps me separate a trade that simply didn't work from a trade that I executed poorly. Sometimes I can do everything right and still lose, because that's just part of trading. Other times, the market isn't the problem, I am. The journal gives me a way to tell the difference, so it becomes my main source of growth, my main source of confidence, and almost a mirror for who I am as a trader, both technically and psychologically. And with that foundation in place, here's how I actually journal. The first stage happens the night before the session begins. In the same way that a lemonade stand owner checks the weather, inventory, and expected demand, I establish the operating conditions before I put capital at risk. My overnight analysis includes the higher time frame narrative, starting at the daily chart, I'll annotate important opens and PD arrays, frame narrative based on premium and discount concepts. More importantly, I build conditional statements. If price does this during this time and confirms in this way, then I am permitted to consider an entry. If the market does something else, I either adapt within the model or remain on the sidelines. The purpose is not to predict the session perfectly. It is to document what I genuinely knew before the session so I cannot rewrite the story afterward. And when I review the session later, I can compare my original expectation with actual delivery and determine whether my narrative was useful, whether I missed a key condition, or whether the market simply selected a different scenario. The next part is the execution record. This is where screenshots become more valuable than a row in a spreadsheet. When I am executing, I want to preserve what I saw, the higher time frame context, the liquidity event, what PD arrays are there and present, what I was looking at, the confirmation, the entry, the invalidation, what targets I was looking for, where I took partials, how I managed my stop loss and position overall. I'm able to record and document all of my management decisions for the setup or trade. Additionally, I can write down any internal dialogue that is relevant. Was I feeling the urgency because I missed the first move? Did I execute a market order instead of waiting for price to offer me a limit fill at a deeper discount or premium? Did fear make me want to exit the trade too early? Was I tempted to widen my stop or trail too aggressively because of how a specific candlestick was moving? Was the decision based on a new market information, or was it based on discomfort? I'm able to write all of these things on the screenshot and associate them with the behavior and price action. A simple psychological prompt is, what was I feeling? What did that feeling make me want to do? And did I act on it? And having all of this information on a screenshot shows what was available in real time, what I correctly identified, what I overlooked, and everything that was going on inside my head at the time. The third part is the post-trade review. This is where I close the books on the decision and I record the results in P&L and the risk to reward, total risk used, and the number of attempts. I review the operation itself. Did I follow the protocol? What I did well? What could I improve? What is the clearest technical lesson? What is the clearest psychological lesson? I don't need to write an essay after every trade. I just need enough information to reconstruct the decision and refresh my memory later. The review should answer two separate questions. Did I make money? And did I operate professionally? Keep in mind, those answers are not always the same. Doing this over time and reflecting upon it can help you become detached from the outcome. Alright, this matrix is one of the most important ideas in the entire video. Good execution that wins is a deserved win. Repeat the process. Good execution that loses is an acceptable expense. One valid loss does not automatically require a model change. Poor execution that loses is a preventable loss. Find whatever rule that you broke and correct it. But poor execution that wins may be the most dangerous outcome on the screen. The profit can reward a bad habit. You over-leveraged, chased, ignored invalidation, broke your time window, and the market happened to pay you. If your journal only celebrates the money, you may repeat the violation with more confidence next time. Remember, the goal is not to eliminate losing trades. That is inevitable. You're going to lose. The goal is to eliminate losses that should never have been taken. Every real business uses KPIs. ICT speaks on this a lot. A lemonade stand might track the cost of lemons, revenue per cup, daily margin, wasted inventory, and which hours produced the most demand. In trading, you can track average loss relative to risk used, average win, expectancy, weekly and monthly return, drawdown, and performance by setup or time window. But the useful KPIs are not only financial. I also want to know whether I followed the risk protocol, how often I took an unplanned trade, how often I exited prematurely, and which emotional behaviors keep appearing. Some of these can be simple tags: FOMO, revenge impulse, hesitation, fear of engaging, overconfidence, or aggressive stop management. Over a meaningful sample, the frequency becomes the evidence. Through KPIs, you can refine your process, identify patterns, and improve your decision-making based upon it. At the end of the month, I want to step out of the role of trader and into the role of a business owner. Did I produce the return I expected? How much risk did it require? Which setups and time performed the best? Which rule did I violate most often? What was my costliest technical mistake? What was my costliest behavioral mistake? And what should I continue, stop, or adjust for the next month? One trade is a story, a month of trades can reveal a pattern. This also prevents me from redesigning the entire business after 2 losses. A valid loss is not automatically evidence that the model is broken. I want enough observations to separate a normal variance from a recurring weakness. A professional business also defines what enough looks like. You have to learn to be content with enough. This is an example of an illustrative weekly target. It's simply an example. Your objective should fit your own model, your risk tolerance, and evidence. My current planning benchmark, for you this may be 1% per week, 1.5%, 2%, or 4 to 5%, depending on what you're comfortable with risking and what your system and model looks like. It's important to treat this number as a benchmark and not a quota that you force upon the market to pay you. The principle is more important than the number. If the business has already accomplished its objective, I do not need to keep exposing capital simply because another trade might appear. Depending on the plan and the quality of the opportunity, that may mean stopping live exposure, tapering risk, or becoming much more selective. The danger is turning a successful week into an avoidable setback because you were unable to accept enough. It is also dangerous to turn a target into pressure and begin forcing trades because you think the business is behind schedule. Let's assume your weekly target is 2% and it's Thursday and you've only achieved 0.5%. Does that mean you need to force a setup to meet your weekly target? Absolutely not. If something presents itself and it meets your criteria, you can execute upon it with sound risk management, but you certainly do not need to force trades because you're afraid of not meeting your weekly target. On the other hand, if you meet your weekly target, the work does not have to stop. You can tape read, paper trade, annotate developing setups, review prior sessions, and practice without risking capital. The risk may stop, but the learning always continues. Now I'll show you how I organize all of this in practice. My Discord server functions like the office of the business, and each channel has a specific department. As you can see, I have a channel for the overnight analysis, which preserves the narrative, key levels, annotated charts, and conditional scenarios before the session. I also share this on my X page every evening for everyone to view, and I basically just link my public X post. And if I ever want to go back and look at any of these, I can simply navigate to the specific date and access the link directly from here. Next, the execution charts channel contains the decisions that I actually made. I'm capturing the screenshot with annotations, entries, exits. I'm writing down my internal dialogue and reflections. And again, each post is a separate execution. So this is my most recent one on August 25th in the PM session. And this was simply a paper execution for practice. I write down my initial risk and my gain in terms of percentage and dollar amount, my risk to reward ratio, because even though it's practice, I still want to ensure that I'm practicing good risk management. Here are my annotations, which I also shared publicly on X. I can always look back and understand the context of the setup, what made me frame the narrative in the way that I did, what higher time frame PD arrays I was looking at. In this case, I was looking at this 15-minute reclaimed fair value gap. You can see my annotations here on the 5-minute chart. This is the dialogue that was going through my head at that point in time. That's what I have written down. I was observing how price simply wicked into the midpoint of that 15-minute fair value gap. The bodies are remaining beneath the fair value gap low. That is bearish order flow. And I executed this particular trade on the 2-minute chart. You can see that it's within the macro. Again, writing down everything that was going on in my head. I'm observing the bodies remain beneath the low. I'm writing down why I executed at this particular candlestick. When this down close candle, the one before my entry here, when it closed in the lower half of the inversion fair value gap, I immediately sold at market, trusting that the sell program is now set to begin because everything going on here indicates the order flow is bearish. Just entered a macro, seeing that premium sensitivity at the 15-minute fair value gap. I am trusting the fact that price will now work lower. I have all my annotations of the PD arrays that I was observing, this tiny little volume imbalance in here. I've also written that down, how price is continuously showing premium sensitivity at each PD array, which is indicative of bearish order flow. I can go back and see why I took a partial here, because it's near the equilibrium of the dealing range. So that's the logic that was going through my head at that moment in time. I took 2 more contracts off at the opening price of the bullish order block here, in the case that price sees discount sensitivity, especially because it's delivering to the discount portion of the range. I have my trailed stop level here as well, annotated, which is where I get stopped out on the remaining 2 of 9 contracts because price failed to reach the terminus. And I'm also writing down the importance of aiming for low-hanging objectives, especially during the week of Jackson Hole Symposium, where price is likely to be range bound and have sharp, violent retracements, as we can see here. So this is just an example of how I annotate my executions, how I journal my setups, how I'm writing down my inner dialogue, and how I document, store, and organize all of these in a way that works for me. And with the screenshots, I add a reflection on, how I felt, what was going through my head, what I did well, some things that I could improve upon. In this case, I could have waited for the candle close on the 5-minute chart because at 3 p.m. price had a wick back into the inefficiency that I used for the entry. So what I'm referring to here is this large premium wick was formed at 3 p.m. I executed prior to the 5-minute candle close. So had I waited for 3 p.m. and the 5-minute candle closure, I would have still been filled on my order, and perhaps I could have gotten a better discounted entry as well in the upper half of the inversion fair value gap. But you can see how overall I'm being very positive in my reflection. I'm backing myself up. I'm using terminology that helps build my confidence in my technical skill set, my trade management, my ability to read price. And what this does is subconsciously it helps you become better and grow into the trader that you aspire to be. And this is something that ICT speaks on a lot as well when he's speaking on the topics of journaling and backtesting. So this is something that has really worked for me. It's been very helpful for me, and I would highly suggest that everyone does the same. I also have a channel for session reviews. I'll just go in and annotate on how price delivered to specific levels during any particular session, whether I engage with the price or not on that given day. And over time, it's helped me improve on my ability to pick up on what price is likely to do next, what the purpose of a specific delivery in price is. So for example, how price broke lower right here after 9:30 open. I'm able to identify here that it's to trap breakout sellers and absorb the sell stops beneath the sell side liquidity. It's also digging into the daily bullish order block. And since I'm already bullish on the higher time frames, I can expect discount sensitivity here. I have specific key levels annotated as well. I have the midnight open up here. I'm using the first presented fair value gap. And you can see how annotating all these levels, writing down your thoughts, what you're expecting in price, and doing these exercises, it can really help you develop. I build my foundation in my understanding through studying ICT's concepts directly through him. However, going through the process of studying on my own and applying the concepts firsthand by doing similar exercises where I'm explaining price delivery, I'm annotating charts in this fashion for different sessions, using different concepts. Here I'm using the 7 a.m. to 9 a.m. dealing range, graded into octants. Having done these things consistently over time and applying the knowledge that I've gained through the videos and the mentorships, that has what's helped me develop the most. And this is something that ICT also reinforces. Had I just simply watched the videos and taken notes, I really believe that I would not be at the level of understanding that I'm at currently. Still have a lot more to learn and grow in my own development. And I'm continuing to improve by doing the same process over and over again. It may be tedious, it may feel boring, but this is exactly how you get better. Finally, the trade journal section handles the measurable side of the business. Because I'm using the Discord server, I've set up the bot here with the ability to import CSV files of my executions directly from my broker. And this allows me to speed up the process of logging the numbers of the execution. My entry price, my initial stop loss placement, the partials that I take, my terminus exits, all of that I can very easily import through the CSV file. So the whole point of this is to simply make the logistical step of logging the records of the trade more easier for me. I can also keep track of my portfolio and my weekly progress, just so it's readily available to me. So I'm doing that as well. I'm not going to do that here because that's personal to my own account. If I need to ever manually log a trade, I can do that here. I've also set up a protocol command, which helps me remind myself of the risk management protocol that I've been placed on myself at the moment. So right now I'm limiting my risk on my live account to 0.5% on my first attempt, and I'll allow myself a second attempt of half risk if I get stopped down in the initial one. And the whole purpose is to mitigate loss that second attempt. This allows me to keep my daily loss capped at negative 0.75%. And if there's ever any slippage or execution errors, my hard stop on a given day at the moment is 1%. And that is extremely conservative in my opinion. For the week, if I'm ever in a 1.5% drawdown, that is my hard stop. I do not trade live after that point. And my weekly benchmark, it's not really a target or a ceiling, is 1%. Because I'm risking such little capital, I'm also not demanding a whole lot of return on a weekly basis. Does it mean that I limit all engagement after I reach the 1%? No, but I'm going to be more selective on weeks with uncertainty, like this week, for example. We have Jackson Hole Symposium. I'm not going to be trading with live capital if I reach my weekly target. However, on other weeks, if a setup presents itself, I may allow myself to risk a fraction of the surplus that I've gained on top of the weekly benchmark to engage. So the whole purpose of this is to just help remind me of my risk protocol as I import my CSV file with my executions. The bot will send me an update on how my weekly progress is and how well I'm following my risk management protocol. This is all simply just logistical stuff, and it's simply what works for me. Discord is simply the platform that currently fits my workflow. It is not the lesson. You can use whatever works for you. You can use Excel, Google Sheets, Notion, pen and paper, or a combination of tools. The non-negotiable functions remain the same. So you have to preserve the analysis, you have to capture and annotate screenshots, you have to document the execution, you have to measure your performance and compliance, and you have to review your recurring patterns. So choose a format simple enough that you will maintain consistently and find something that works for you. For me, having a personal Discord server with the bot functionality helps me stay organized and makes a lot of things simple. For you, it may just be pen and paper. So the best journal is not the most complicated one. It is the one you actually keep using and the one that makes your behavior difficult to hide. For me, screenshots and annotations are the most valuable part of the entire system because they train my attention. I mark out the liquidity, the relevant PD arrays, my entry, exits, partials. I write down what I saw, what I missed, and then I compare the scenario I planned with the delivery that actually occurred. You'll often hear ICT talking about your reticular activation system and how important it is to train it. And the best way to train it is to tape read, take screenshots, annotate your charts, write down your inner dialogue, write down what you're observing, and over time, you will build confidence from a growing archive of evidence that you've seen and practiced repeatedly. You'll be able to spot different PD arrays before they even form, and this is the number one thing that's helped me improve very quickly and efficiently. So repetition is what builds confidence. Right? Ultimately, this is the reason I journal, to identify repetition. Behaviorally, that might be overtrading, over-leveraging, FOMO, revenge trading, fear of engaging, or overconfidence after a win. Technically, it might be buying in a premium or above old highs. You're selling in discount or beneath old lows. You're placing stops too tightly. You're perhaps trailing your stops too aggressively. Maybe you're taking partials too frequently and you're not allowing the trade to play out. You may be entering prematurely before any confirmation, or you're repeatedly misidentifying the draws on liquidity. And when you're making the same mistake over and over again, that's a pattern that becomes visible. And journaling helps identify these patterns. And once you've identified a pattern, you can make a clear adjustment or prohibition and practice that specific weakness through tape reading and review. So what journaling does is it turns a vague feeling like I need to be more disciplined into a specific observation. For example, let's say 3 of my 5 avoidable losses came from entering before confirmation. I can make a very clear-cut rule that I have to wait for a 5-minute displacement candle. That is actionable. Last but not least, remember you are allowed to be wrong. You are allowed to take loss. You are not allowed to manage them recklessly. Your whole job as a professional trader is to operate like a professional risk manager. If I owned a lemonade stand, I would know my operating costs, my budget, my expected revenue, and the behaviors that threaten the business. I would keep records, review performance, and stop reckless spending before it endangered the whole operation. Trading should be the same way. Your journal needs to preserve why you took the trade, whether you followed your rules, how your emotions affected the decision, and what keeps repeating over time. You're going to be wrong at times, and you're going to take losses. That is absolutely inevitable. Journaling helps you operate professionally enough to survive, learn, and compound. It helps you build an archive of evidence to look back upon and build confidence to develop into the trader that you need to be to succeed. If this was helpful, let me know what format you use for a journal and what part of your process you're still trying to refine. Make sure to leave a like, comment, and subscribe if you haven't already, and go follow my X page in the description box below. Thank you guys for watching, and I'll see you next time.